Hi, this is Raghee Horner, and I wanted to put this particular video out here on the blog for everyone to check out because probably one of the most popular questions I have got over the past couple days is what the heck happened in gold and how do I even deal with it? And the first thing I want to tell you is that not every market move is going to make sense. Not every market move is going to be tradable. And not every market move is going to be one that we can go back and say, okay, here were the clues that we missed. But having said all that, gold was not one of them. Gold was not an exception. There were actually a lot of very good clues into why gold did what it did. I'm not saying that we can ever predict or project the velocity at which we see a move, but I have to tell you, the move itself should not be unexpected. So let's go ahead and pick a few charts apart. I'm going to have to kind of go back in time a little bit. We know what's happened, obviously, so I'm not revealing anything in terms of a surprise ending. You guys know how this story ends, but I want to go back in time and show you some of the clues so that you can train your eyes to recognize these on your own. So let's start off with the daily time frame. And certainly there's just no question that gold was in an uptrend. Okay, we can see that the criteria that I would use, and for those of you that have been following me for any length of time and my premium members, you know the criteria and so forth. Would we have called this a 12 to 2 o'clock uptrend? I think you know that we would. It wasn't necessarily smooth, nor was it established. Those are two of our clarity criteria for psychology, but the culmination of green grab candles would certainly indicate what? At very least, bullish sentiment and bullish momentum, even if we weren't wowed by the quality of the uptrend. So that's the first step. So we would definitely be bullish. And that's not necessarily a bad thing at this point because up until that sell-off, that was the way the market was moving. So I'm not going to start thinking counter trend just because the market is maybe overextended, or maybe because I feel like, I want you to think about this one thing really quick, and I don't want to go off on a tangent. One of the biggest mistakes I see traders making every single day is that if they are not already long in a market, or if they don't have a buy setup in an uptrend, they immediately jump to the counter trend. And it really is, I have to tell you, a form of revenge trading. Because people who are long are not worried about getting short, are they? The only people who are interested in getting short in an uptrend, and this also works with people wanting to get long in a downtrend, is because they're not already in the trend or they don't have a strategy to capitalize on the current trend, so they take the opposite side. It's really revenge trading in a lot of ways when we're talking about the context of a trend. Now, we talked about the fact that here on this daily chart of gold, and I'm actually using the XAU, so this is spot, but it's the same story. We see that we have the shaky uptrend, but certainly bullish sentiment and momentum as reflected by our green grab candles. I do want you to do a couple things. We don't live on the left side of the chart, but the left side of the chart does often reveal some important levels that we need to respect. And unless we do this from time to time, we are absolutely going to miss out on those areas, those decision levels where sentiment could shift. So in this case, we have an area at, this high is 1802. Now, for those of you that follow me, you know what I'm going to say right now. 1802, $2, 2 points above the 1800 major psychological level. I love when I get predictable. I love when people kind of already know what's going to come out of my mouth because you've been listening to me and you know the guidelines by which we're going to operate. 1795 is the other high that I want to respect. So you guys know anytime I talk about a major psych level, I talk about an area. It's not just the 00, although that is kind of the apex, but it's just above and just below that sometimes we begin to see the fatigue. In fact, I can just put in here to make that point a little clearer. I want to put in 1805 as well. Now I'm going to make this a dotted line because it's not necessarily a past high, but I want to make sure we put that in there as well. So we have 1800, 1795, and 1805. Okay? All right, so all those lines and levels are in there. Now, let me ask you, were we nearing 1800 before the sell-off? Now, let's take a look at some of the highs before the sell-off. We had a high right here at 1786, not really quite there. We had a high here at 1789, getting closer. And what was the high of the candle before the breakdown? 1790. So we were creeping anywhere from 14, back here at 1786, is that what we said this high was? Yeah, 1786, 1789, 11 points or dollars to 10 points or dollars away from the 1800 level, and where we have, by the way, seen previous resistance. So this isn't just a major psychological exhaustion expectation. This is looking to the left, looking at history and saying, you know what, this is where sentiment has shifted before. There's a good chance it's going to do it again. So let me ask you, even though we're moving up higher, until or unless we do battle at 1800, should I expect that we're going to see strong follow-through higher? Because that battle I'm talking about works out to look something like this. You know, we might pierce that level, then we come back to test it, and then if we have the buyer stepping in, we might move up higher from there. That's that battle I'm talking about. Sometimes we'll come up to it, and then we'll be rejected. And then we'll retest it again maybe, and then we'll go back down lower. You know, I don't know what that battle is, but I have to wait for that battle, and I know where the battleground is based upon the past price action. So having said all that, we always start here with all our analysis on the daily time frame, because it's these types of clues that will, and let me mention, this chart would have us bullish in terms of expectation for movement on our intraday time frames. Let me say that because our directional bias before the breakdown was more bullish than bearish. So what the daily chart has told us is two things. One, we're nearing an area that we could do battle at, and we could accelerate or we could exhaust. There's only three things a market could do at a decision level: accelerate, exhaust, and reverse. Then what we also know is that we are overall in an uptrend, which means that if I'm going to take a counter trend trade, it would be limited to short-term time frames. Another thing that members know when we have this scenario is that when we are nearing a level at which we could start to see the battle occur, we also want to retreat to those short-term time frames and do, as I often say, stay nimble. So there were three reasons, or actually there was one reason we wanted to stay bullish. That's the angle of the wave and definitely the grab candles. But the other two reasons that we did all this work to show you that we've exhausted here before, we're dealing with a major psychological level, and there were plenty of reasons to stay nimble and stay on the short-term time frames. Okay, so I hope all that makes sense, because now when we go intraday, we'll start putting it together. So short-term time frames for me mean 5, 15, 30. I'm just going to go through each time frame here and show you what things looked like before the breakdown. Up, 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 up. And then we start to see a little bit of slop. Oh, actually, no, I'm way too far back. Hang on. There we go. There's the up, 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 up. Okay, so we're moving higher, higher, higher. And then we can see here the way we slice down. So this was actually a chart that at the time was in an uptrend, triggered a swing buy, actually a couple of them, started to lose a little bit of the uptrend before the break. Now, as we're nearing this area close to 1800, everybody who's a member knows we start to actually protect our position. So if we got long, we want to at least start thinking about the fact that we're nearing an area that prices could do battle. But my members also know getting close to that battle means we won't be on such a long-term time frame, because we don't expect longer-term organization against the upcoming resistance. We don't want to expect, nor do we want to require a higher high to make our trade work. So again, members know we wouldn't be on such a longer term time frame. And if we were, we'd have to respect the ability for the market to turn on a dime at that point. What about the 1 hour chart? We had a swing type angle, but not probably one of the best we've seen. Would this be a swing buy? Well, again, members know that 1 hour charts are slightly longer term. So for the same reason we likely wouldn't be trading on the 4 hour, we likely would not be trading on the 1 hour either. It doesn't give us a strategic advantage in terms of psychological clarity. So it's not that we wouldn't be buyers, just wouldn't be buyers in the 1 hour and the 4 hour. Okay, let me make that clear. It's not that we would not be buyers of gold. It's simply that we wouldn't do it on the 1 and 4 hour time frame as we were nearing the battle at 1800, where we had also seen resistance pile in before. That brings us to our shorter term time frames, like the 30 and the 15 and the 5. So here's the drop. Now what preceded the drop? What type of price action? Kind of a nice uptrend here, isn't it? I think if this is what I was looking at the time, no question, I would be a buyer here. Okay, I'm not trying to insinuate in any way that we had a short sell before that breakout. We would definitely be buyers here. Anybody who follows me in terms of swing trades know if you have bullishness on that daily, trend following is looking for those buying opportunities. We had 1, 2, 3, aggro here 4, another aggro here 5, and then what happened? This happened. I'm telling you right now a couple things. First of all, the main thing to point out is the swing buy got stopped out there. Regardless of where you got long, if you were managing this or whether or not you took this very last one, at this point right there, I'm going to make sure I highlight these candles. Right there, your swing buy got stopped out, period. And we're losing our angle of our 34 EMA wave, so there's no reason to set up another. That's swing 101. Everybody who knows my trend following knows this is stopped out. That is swing 101. At some point after getting stopped out, you're also going to notice the exhaustion that's accompanying now what is much more of a sideways, kind of lumpy, bumpy wave. Again, members know where we set up here. We throw a stochastics on this chart. We start looking for maybe distribution fades, right? Either buys along the floor or sells along the ceiling, right? We also know the 30-minute chart, the 15 and the 5 are the only time frames that will allow us to get short if the sentiment and momentum starts to turn more markedly bearish. We're only going to fight the sentiment, momentum, and trend on short-term time frames because at this point in time, getting short would have been counter the direction we were seeing on the daily. And we don't want to expect longer-term organization against the dominant psychology of the daily, which again was definitely bullish. Okay? So anybody who's telling you that they were very bearish on the gold market before the drop, I mean, I just, for the life of me, can't see why that would be. In fact, I'm telling you now, up until that drop, we were looking at swing buys and had a really good time doing it until it stopped us out. Then what happened? Well, for those of you that typically follow me, you know that the distribution fade was one option and the wave CCI was another. But I'll tell you, all this chop here likely would not have triggered a wave CCI for us. I would not have alerted it because it was just too noisy. Too much noise in order to get a clean trend reversal. So I'm not going to tell you, although I would have loved to have told you that, yeah, we triggered a trend reversal back here. I'd be hard-pressed to tell you that either one of these candles would have inspired a lot of confidence in me to trigger a trend reversal or what I call a wave CCI entry. Would have loved to have told you that's the case, but based on what I see on this 30-minute time frame, that just would not be the case. Okay? But you know it's coming, right? You know it's coming. Let's go to the 15-minute time frame. So let's go back in time here to the 15 before the drop. Now the 15 really was pretty interesting, okay? Because the 15 had transitioned out of its uptrend. And by the way, we would have had those same swing scenarios in the 15 than we did on the 30. Lots of, in fact, we even had the 50-period simple moving average here really working into the conversation, acting as support as well. So not only the wave support, but we had the 50-period simple factoring in. And two things. One, some of you might have gone ahead and thrown in the towel when the wave was broken here, although that really would have been neglectful of how important this 50-period simple had been. But certainly that's valid if you decide, hey, I've had enough here. I've had 1, 2, 3, 4, I've had 5 different opportunities, 4 to 5 different opportunities to ride this market higher. I'm done. And I'm done accompanied what? Look at the angle of the wave. Look at how the steepness of the wave here, started to really transition. We lost a lot of that angle. So subsequent swing buys here, even though we pushed up to another high, would not really be valid, or they would be valid within the context of a shallower swing angle. And all this price action, by the way, that preceded the sell-off, if you do your daily directional bias homework, would have started to really reflect the battle starting to gear up around that major psych area. We can already see the exhaustion on the 15. I'm not saying this is something we'd expect a dramatic sell-off from. If all we'd probably do with this view is put up a stochastic and look for distribution fades, and that would simply look a little something like this. Okay, we look for those distribution fades. High overbought, high overbought, high. No overbought here. Interesting. No overbought there. So we'd be looking for those distribution fades. We wouldn't really be bullish anymore. We have a lumpy, bumpy sideways wave, which means that on the short-term intraday time frames, we're losing that bullish sentiment and momentum. Okay, this is really important in terms of the transition that we then see. Boom. Okay. Now, for some traders, looking at these 3 days of price action, for some traders, again, these highs are really appealing because of what? And let's pull that distribution fade scenario back up again, because I really want to be as transparent about what was going on here as possible. So this low here and this low here, these would have been possible areas that we would have thought about for a distribution fade. Right there and right there. And those of you know we keep a very tight stop on these. So our stop would have been just a few. Let's see, this was a low of 79, so 1779.50. So we wouldn't give this thing more than a few points. This was a low of 77.64. We keep in fact, on the Forex side of things, we keep our distribution fade stops 10 to 12 pips. Okay, 10 to 12 pips. If you were to transfer that over to something like the XAU, we're talking about 10 to 12 pips here. So very tight. Either prices step in and support right around these previous lows, or they don't. So this would have definitely stopped us out back here because of how tight we keep our fades. It really didn't show that the support zone held. That wouldn't have triggered that would definitely not have triggered a buy, okay? But as we basically got out of, what I want you to really see across all these different time frames is not that it positioned us so effectively for some kind of short. What I want you to see is there was very little reason to be long anymore. And sometimes that's more important. There was zero reason to be long anymore. Time frame after time frame on our short terms, 30, 15. We had buys that were valid, and then they stopped being valid. And I got to tell you, when a market transitions its psychology, it is so important to respect it. Because if you don't respect this could be what's waiting. Now again, this is a really dramatic example, right? And dramatic examples seldom really turn into good educational lessons, but this is really an exception. This is not about how we position ourselves to capitalize on this. This is really about how, if we don't pay attention to the signs of a psychological transition, we will be long during something like this. I hope you see how much more valuable that is. A lot of people are saying, how could I have taken advantage of this? My point is, it's not even about having taken advantage of that. It's about dealing with what was a very bullish market that suddenly just fell out of bed and down the stairs and into the basement. Okay? So a lot of traders are focusing on the absolute wrong thing when it comes to that move, which is how could I position to short? That's an anomaly move. I'm not looking for these types of moves to make my day, to make my week, to make my month. These are moves that I actually want to avoid within the context of what had been a very bullish market. And I hope you understand how important that is, because we enjoyed the ride up when the market trend was healthy and bullish and trend following. And notice time after time, we would have been out because the psychology shifted. And here's a big lesson here. Unless you have a methodology and a way to alert yourself to these shifts in transition, which is exactly what we focus on at TFF, day after day, video after video, webinar after webinar, unless you have a way to recognize these, this could sometimes be your fate. And that is the lesson for today. I hope it made a lot of sense. I hope that it got you thinking about where you were in terms of your selection of time frame, respect for the directional bias of the daily, and therefore, and also psychological level, and therefore how you dealt with the transition psychology that was abundantly clear across the short-term time frames, which is where you should have been. I hope I explained all that. Come this move lower in gold. All right, so if you've hung out with me for the entirety of this gold discussion, you are going to love what I'm going to be doing this Wednesday. Yes, in 5 days on Wednesday evening, and that's going to be March the 7th. We're going to start off a 24-hour Trade the Globe webinar where actually we're going to trade in small pockets during those really good, valid trading hours for the market, starting off with Wednesday night's Asian session open, take a break, go into the Paris and Frankfurt session open, take a break after the Asian session close, and really get into the active hours for the U.S. session comes Thursday. Now what's really cool about this is this will all be leading up into Friday's non-farm payroll. So even though we're going to wrap up Thursday afternoon, you'll get a pretty good idea of what I'm thinking about for Friday's non-farm payroll, and interspersed throughout my trading, my live account, showing you live trading setups and things that I'm actually doing. I'm going to be teaching you how and why I'm taking trades, how to set up the trades, how I'm actually putting in the orders, so you'll see my order ticket, and how I'm setting up proactive orders, how I am putting in my profit targets, stop loss considerations, everything. So basically I'm going to be talking you through my trading day. So I've never done this before. I don't know that I'm ever going to do it again, but it's going to be a really cool challenge for me. And I'll be stocking up on some Red Bull come Wednesday afternoon. So if you want to join me for this 24-hour webinar, here's the deal. I can't make it any sweeter than this. Basically, Trade Forex Futures is going to allow me to do this webinar, and I'm going to be giving you 30 days to TradeForexFutures.com. If you are a fan of Forex AM, I've got a sample of it back at the blog at TradeForexFutures.com/blog, or click on the Raghee's blog link at TradeForexFutures.com. If you're a fan of Forex AM, you'll love the daily video updates because I do that twice a day. In-depth discussion of all the setups I'm looking at, the different scenarios that I'm considering, and then the trade build-out. And if you're a little bit newer to trading and that Forex AM was a little too fast-paced for you, I've got a daily trading lesson every single day. It's going to talk about the current market environment and setups that I'm looking at, but do it in a much slower pace. Do it in a way that if you're not 100% up to speed with how I trade, you're going to get a lot of those nuances and steps and mechanics. In fact, last night I actually traded the Aussie US dollar, and I showed you how I set the trade up as I was taking it. So those daily trading lessons are not only looks at the current market, but it's a little slower paced look at how you can identify these on your own. So you get 30 days to everything that we offer at TradeForexFutures.com. You get the Wednesday, Thursday, 24-hour Trading the Globe webinar. And basically all you need to do to kick the tires in this one is $10, $9.97. Head on over to TradeForexFutures.com/join. Come hang out with me Wednesday and Thursday. See if it's the kind of trading style that suits you. That's why we like having these trials. I want to make sure that we find traders that are going to get the most from the videos and the information we offer there. And again, if you like this gold video, you're going to love that webinar on Wednesday and Thursday. See you in the next video. And hopefully see you at the webinar.